Hey guys, what's up? It's Paul and welcome to today's video topic. If you're new here, my name is Paul Lajoie and I'm founder of Biz by Pro. And over the last 25 years, I've accumulated, bought, sold, operated over 20 businesses and accumulated a net worth of over $20 million. Welcome. I appreciate you're here. Let's dive into the next topic at hand. And I love comments afterwards. Thanks.
10 red flags from the IRS on your tax returns, both corporate and personal. Probably a few extra little bonuses I'm going to throw in there as well, so please listen. Unreported income. IRS is very sophisticated. They're matching a lot of stuff behind the scenes. You get a transaction, someone pays you $10,000. What's an expense on their side, right? So they're looking at those tax returns, mirroring it up to your tax returns. Unreported income is probably the number one audit red flag, and they will find it. And if they find it, they will scrub your numbers for multiple years. So that one is super important. Don't try to cheat here, right? Cheating is fraud. Fraud, you go to jail, right? Not talking about something you missed on accident. That is fine. But if they think it's fraud, you're going to go to jail. Okay. Home office deduction. Just don't take it. Nobody should take it. 99% of the people in the United States do not qualify for it, which means you have to have an exterior door going directly into your office. 99% of the people don't have it. So don't take it. Don't take it. They know what's going on and you're only saving a few $100 at most. So why do it? It's just stupid. Vehicle expenses. This is massively big one. Okay, the IRS knows that very few people use their automobiles 100% for business. I use mine probably 60 or 70%. And I report it as is. There's a number on the tax return. How many miles did you drive? 30,000. How much was driven for business? 20,000. You say 30 was driven and 30 for business, you're going to get audited. Don't do it. They're going to find you. Travel expenses. It's a big one. A lot of people traveling with their families or just taking personal vacations and writing it off as a business expense. Don't do it. Some are legitimate. I get it. Some are legitimate. You're going on a big old junket where you're going to a consortium of some sort or a speech or training program or things like that. And if your spouse goes with you to that stuff, yeah, you're writing off 100% of it. Just be super careful there, right? They're going to look into that. Meals and entertainment, same thing, right? You got to follow the rules here. You got to make sure it's a business purpose. You got that person with you, et cetera. Same thing with just meals, right? You've got to have a business purpose. Keep receipts, okay? So if you're going out on a dinner, keep receipts. If without a receipt, it's not a valid deduction. Contractor payments. You got to make sure that there's a relationship there, right? You just can't just pay somebody $10,000, right? For all they know is you just wrote a check to a friend and he's paying you back with a personal check and you wrote that off as a business expense. They're going to find it. They're going to ask, what's that relationship with John Doe or Jane Doe? Where's that customer client business relationship? Where is that? They're going to ask you questions. Expenses paid in cash. This is a big one going on right now too in the eyes of the IRS, right? So a lot of things are being paid cash. Zelle, Venmo, PayPal, whatever is being paid in cash, right? There's a lot of stuff going on right now that you have to report anything over $600 to the IRS that you paid under Zelle and Venmo and vice versa. And Venmo and Zelle are going to be doing reporting as well. There's all sorts of matching going on. So if you're doing $50,000 worth of transaction in Zelle's sending that information to the IRS and the government. And they're going to find you. And they're going to want to know where all of that income and or expenses are. Be very, very, very careful. Capital assets, treating as expense. You buy a forklift for $100,000. That is a capital asset. You're supposed to depreciate it over its useful life. Let's say that's 5 years. You should be depreciating $20,000 a year for 5 years, not writing the entire thing off. I understand there's Section 179. I understand there's special 100% depreciation right now. I get it. Those may not be there tomorrow. Okay, so make sure you're accounting for that properly. Hobby losses. You can't have a business that loses money every single year. Let's say you have a horse breeding farm and you lost money for 20 consecutive years. That is a hobby. That is not a business. Okay. I don't know what the cutoff is in years. I'm thinking it's anywhere between 5 to 7, but I'm not 100% sure. Okay. You can still do the horse breeding. Just can't take it as a business deduction. Okay. Excessive charitable contributions. Again, the IRS is smart. They're running your tax return through a computer and they're doing matching stuff and ratios and percentages. So if your income is $30,000, you're just going to send $30,000. How many people are taking $15,000 of charitable deductions? And their income's only 30, probably close to zero. And if you do it, you're getting audited, right? You may be the outlier there and you did $15,000 in charitable contributions. God bless you. That is awesome. If your $30,000 in income is it's an outlier and it's low, and your income the next year is 150, can we bunch those deductions up and take them the next year when your average tax rate's 30 versus your average tax rate's probably less than 5 when it's $30,000 in income? Let's make sure we're bunching deductions and going with the year where your income is the highest. That's going to save you money. Okay. Excessively round numbers. Just write off $2,500, $2,750, $3,000, $1,000. Those aren't real numbers. IRS knows it. Write off $1,123.97. That's a real number. Okay. Mentioned already chronic business losses, and along with chronic business losses, there's Schedule C. So if you're a sole proprietor, you're running all your income and all your expenses through Schedule C. Schedule C itself is a massive red flag. Those are mostly sole proprietors. It's just them, consultants that are receiving 1099 income, etc. They normally don't incorporate or don't set up a legal entity, an LLC, a partnership, etc. And they do everything, all their accounting for their taxes on Schedule C. And the IRS knows those are habitual people that make mistakes and cheat on their taxes. So if you are in a valid business and you've been in business for a year or 2 or 3, and it's a going concern, it's going to be around for multiple years, let's go ahead and set yourself up a legal entity, an LLC, a partnership, C Corp, S Corp, whatever. Get off of Schedule C, because that's a massive red flag. If you do have a legal entity set up for your business, you need to make sure you're paying yourself a reasonable salary in the eyes of the IRS. And we want to backtrack on that. So if you hired a manager to replace yourself, how much would you pay that person? 60 grand? You need to be paying yourself 60 grand. Don't pay yourself more. It's bad taxes. Don't pay yourself 100 or 150. Nope. Don't do it. Pay yourself a reasonable salary for the work you're doing. Not more, not less. Okay? Let's see if I missed anything. Gambling losses is a big one. Gambling losses can only be deducted against gambling winnings. If you won $50,000 at blackjack and you lost $20,000 in that same year, you get to take that loss against those winnings. If you don't have any winnings, you don't get to deduct any losses. Okay. High medical expenses, same thing with charitable contributions. So again, if you have $30,000 of adjusted gross income, do you think the IRS is going to believe you when you write down $20,000 in medical expenses? It could happen. I'm sure it does happen. Just be super careful when you do that because you're going to get audited. Okay. So really the whole premise of this thing is just be careful. One, have paperwork receipts, know what you're doing. And then even if it's a valid deduction, right? I don't take a home office deduction in my house. So I qualify for it. I don't take it. It's going to save me $300 or $400 or $500 in taxes. One, it's not worth my time to account for all of that stuff. And then secondly, it's an audit red flag. I don't want to get audited ever. So be smart with your deductions. Do they save you enough money? Is it worth the headache, right? It may take me 2 or 3 hours to account for all of the home office deductions, and I'm going to save $500. My time's worth more than $500 for 3 hours of my time. That's $160 an hour. I make a hell of a lot more than $160 an hour, so it's not worth my time to do it. Audit red flags. I just listed them all. There's a bunch of others too. Some a little bit more sophisticated. I'll get into other videos. But these are the main ones. Be careful.
I hope you enjoyed the video. If you want to learn more about how to acquire a small business and really transform your life and create generational wealth, and you want to talk to me directly about how to do this, click the link below in the description.